All right, so this is a presentation on predicting the stock market using sentiment analysis. I've created a pipeline that analyzes live tweets about stocks from Twitter and then trades those stocks based on their sentiment. So here's a summary of what I'll cover in this presentation. First, I'll touch on the basic ideas one needs to follow along with this presentation, which assume some understanding of machine learning, natural language processing, and some common stock trading terminology. I'll discuss the machine learning models I considered, and then I'll talk about the tools I use to implement my stock trading pipeline. Then I'll display a big picture view of the pipeline I created, and I'll follow that with a deep dive into each area of my pipeline stages. After which we'll take a look at the results of my bots portfolio. And finally, we'll look into some areas of improvement for my model, and then finish up with questions. The purpose of this project was to create an intelligent stock trading bot that makes decisions regarding the trading of stocks based on opinions that people share about the stocks on Twitter. We are focusing on tweets from Twitter instead of well-known media sources because we are interested in taking advantage of how quickly news spreads on Twitter compared to typical news sources. The word intelligence that I mention here is in the bot's ability to make decisions without human intervention using probability. Supervised machine learning is the umbrella term that governs the process of using pre-labeled data and probability to make predictions on unclassified data. In our case, I have a labeled dataset of tweets about stocks and their corresponding sentiment, which I use to train and test my model. Natural language processing is a subcategory of machine learning that allows computers to process human language into vectors of numbers for the purpose of making predictions regarding a piece of text. In our case, we are focused on analyzing a sentiment of text. That is, the text from a tweet is classified as either bullish or bearish, which are terms used in stock trading for projecting how well a stock is going to perform. The sentiment analysis of text builds off of the idea of a language model, which is a probability distribution over a sequence of words. Language models have evolved over the years from n-gram models, which we found struggle with sparse vectors and expensive computation, to neural network models, which we found struggle contextually with a fixed window of words Markov assumption, to recurrent neural network models, which we found struggle with vanishing and exploding gradients, to long short-term memory models, which we found struggle with lengthy training times due to their recursive and computationally dependent nature, to the rather new transformer models, which reduce training times by allowing for some parallel computation to be done during training. And finally, the BERT model is just a popular refined version of the original transformer model. And so I figured, why not just choose the latest and greatest BERT model? These are the tools I used for creating my pipeline. The entire project is written in Python using multiple libraries. The PyTorch and Pandas libraries are used throughout the program to organize and manipulate matrices of data. And the BERT transformer library that I use comes from the developers at Hugging Face. I used Jupyter Notebooks with Google Colab's GPUs to train my model. I then saved that model into a file to be used again as a pre-trained model that could be read into the program. This was helpful to prevent myself from running over Google Colab's GPU computation limit times and allowed me to run the remainder of my pipeline very quickly on my own local computer's CPU. I created a developer profile on Twitter to get access to their API, and then used the Tweepy Python library to extract real-time tweets. Finally, I created a developer trading account on Alpaca's website to get access to their API for use of trading fake money on a simulated version of the real stock market. They also have available a real money account to be traded on the real stock market, but we're not going to go risking that just yet. Here's a high-level overview of my pipeline. It begins with cleaning and pre-processing the dataset of tweets and their labeled sentiment that I found on Kaggle. Next, the data is split into training and testing sets, then siphoned through the BERT classification model, which is evaluated for performance in predicting the test data's sentiment. The model and its predictions are then saved into files so I can reuse them without having to retrain my model with each run of the program. Queries are then made to the Twitter API to pull live tweets relating to stocks, and the model makes a prediction for the sentiment of each tweet. Bullish tweets tally up in a way to trigger a purchase of a stock, and bearish tweets tally up in the opposite way to trigger a sell of a stock. And then this is all done using the Alpaca stock trading API. So the very first stage of the pipeline is data preprocessing, as always. The dataset I'm working with has a rather small sample size of 5,790 tweets. I imagine that someone went through a whole bunch of tweets and just classified them as either bearish or bullish. The cross-entropy loss function that I'm using during training requires all target variables to be non-negative, which required bearish target variables in my dataset to be replaced with a 0 instead of a -1. And then split the data and encoded the tweets to be passed into a PyTorch data loader so that it would be properly formatted to perform attention masking in the BERT transformer model. If you don't know what attention masking is, there's wonderful blogs and articles that describe the ins and outs of the BERT transformer model. The sentiment classifier is built on top of the BERT model and includes a dropout layer for regularization. It then returns an output from the last fully connected layer because that is what is required for the cross-entropy loss function that I use during training. After 10 epochs of training, which may have been overkill for what I got here, the model predicted about 83% of the validation data correctly. It didn't really show any signs of increasing after that many epochs, but I just picked a random number, such as 10, thought it was a reasonable amount of training time, and then it looks as if the training data may have even been memorized a little bit there as it increased. So there's room for improvement here. Twitter allows users to make a developer account in exchange for an API key, which is used to make queries for tweets and other information from their website. In Python, I made a dictionary of popular stock ticker symbols as keys. This here while loop cycles through querying each of those ticker tags, and the API returns a fixed number of the most recent tweets that include a specific ticker tag. Each tweet on Twitter has a unique ID attached to it, which is really just a very large number that increments by 1 with the creation of each new tweet. So by keeping track of the largest ID from a list of returned tweets, I can store that largest ID into the ticker dictionary and update the API search function to only produce tweets newer than that ID on the next query for that ticker tag. Thus, no duplicate tweets are being analyzed. I cleaned each tweet using regular expressions and organized them into a pandas data frame, keeping only the tweet text and the tweet ID. I initially played with the idea of removing retweets, which are duplicate tweets from users who want to repost a tweet from the original tweeter. But I then figured that maybe it would be important to capture the essence of a really popular tweet that gets repeated multiple times across Twitter, which in a way emphasizes its importance on a stock sentiment. Retweeting can be a sign of agreeing with the sentiment from another user, and that's pretty valuable information. The BERT model computes a probability score for both the bullish and bearish classifications for a tweet. Its prediction is simply the more probable value from the two of them. I created the following predict live tweets function to handle the volume of trades that occur as a function of the user's desired risk level. The function determines whether or not to trade a stock based on the certainty of the model's prediction about the sentiment of tweets it has just analyzed. If the user sets their desired risk level to be more conservative, then the function requires the BERT model to be more certain about its prediction before making a trade, thus decreasing the volume of trades that occur. The function keeps a tally for a polarity score, which increments by 1 with each certain bullish prediction and decrements by 1 with each certain bearish prediction. Bullish and bearish predictions that do not meet the specified level of certainty do not affect the polarity score. The magnitude of the polarity score acts as a multiplier in a way on the number of stock shares to trade, and a polarity score of 0 means to do nothing with the stock, which begins to happen more and more often as the user decreases their desired risk. My trading function, Alpaca Trader, as I named it, after the Alpaca API, communicates with my paper trading account on Alpaca's website to make orders for stocks. Initially, it checks if the market is even open for making trades. Then, if the polarity score has determined that I should, say, buy a stock, then the number of shares to buy is a function of many things, one being the equity in the account at the moment, the current account's remaining buying power, the magnitude of the polarity score that it calculated based on the list of tweets it just analyzed, with the adding 1 for each bullish certain prediction and subtracting 1 for each certain bearish prediction. And then it also takes into account the price of the stock itself, which is important for making sure not to buy too many expensive stocks. So this equation was created to avoid buying a large number of expensive shares, such as, say, Amazon stock, which is currently priced at $3,200 per share, because doing so would quickly decrease the account's buying power and portfolio diversity, because it can afford a heck of a lot more less expensive shares than the more expensive ones. So I completed my pipeline on a Saturday morning, unfortunately, and of course the stock market was closed, so I had to wait all the way until Monday to see how it performed. This clip here is a time lapse of the bot trading from market open on Monday morning for about 5 hours. And as you watch, you start to see the bot making money, but it is difficult to say whether it actually performed well or if it was just a good trading day for everyone in the market. So one indication of negative performance in my bot includes the observation that if equal amounts of money were spent buying each of the stocks in the portfolio at the beginning of the day and then held onto until the end of the day, then the return would have been about 2.3%, which is a lot higher, in my opinion, than the 1.8% that my bot returned. On the other hand, the bot did produce higher returns than the S&P 500 and the Dow Jones Industrial Average, although this is largely due to the stocks I picked simply doing really well that day. But the really big idea that I noticed is that there's a strong correlation between the market value of stocks in the portfolio and how the sentiment of the stocks were being interpreted by the bot that day. And what I mean by that is that the sentiment of tweets from Twitter actually guided the trading bot in the right direction to buy more of the stocks with more bullish sentiment and shy away from stocks currently receiving a lot of negative sentiment. So to illustrate this big idea, we'll take 3 out of the top 4 performing stocks in the portfolio from that day, namely NVIDIA, AMD, and Tesla Motors. The market value for a stock in a portfolio is the number of shares owned times the market price for that stock. Thus, we hope that the bot has placed most of its money into stocks that it has seen the most bullish sentiment from on Twitter. Since our bot is using sentiment analysis, it is no coincidence that the bot learned from Twitter to actually buy more shares of NVIDIA, AMD, and Tesla that day because they were performing really well and people were talking about it on Twitter. The portfolio shows the market value for these 3 stocks is significantly higher than all of the other stocks in the portfolio. Thus, the bot intelligently learned from tweets that these 3 stocks were looking bullish that day, and it acted accordingly and bought more of them. Now, one might assume that the market value for a stock is correlated with the price per share of that stock, such that a more expensive stock, such as Tesla, would act as a larger multiplier towards more money invested in that stock. But again, as I mentioned earlier, I programmed the bot's stock purchasing function to scale down in a way the number of shares to buy when a stock is relatively more expensive. This is illustrated by noticing how shares of NVIDIA cost a good deal less than the shares of Tesla. So the bot scaled up the number of shares it could afford per bullish polarity point when buying NVIDIA as compared to Tesla. To summarize this big idea, the bot's intelligence is coming purely from the sentiment of tweets, because it has absolutely no idea how well a stock is performing when it decides to trade it. It doesn't get any input about its trending price or any other kind of financial data. It only makes decisions based on the live opinions from people on Twitter, and that's really interesting to watch. And of course, this bot is clearly not perfect because it missed a beat with the ExxonMobil stock, which was up a whopping 4% that day. So there's plenty of room for improvement. Of course, like any data analyst, I would love to have access to a much larger data set. Additionally, with more time, I would implement some form of cross-validation splitting, since this has never failed to improve any of my models in the past. With more time and multiple GPUs, if I had it, I could get closer to an optimal combination of model parameters that seem to make a difference, such as the learning rate and the dropout layer, through just trial and error of training the model. There's also a surprisingly large number of variables that go into a search query for tweets using the Twitter API. I simply queried for ticker hashtags one at a time, but I noticed that oftentimes people on Twitter like to include multiple ticker tags within this very same tweet, which may or may not be throwing off the prediction. This could be avoided by adjusting the query function. With a little bit more reading into Tweepy's documentation, we could probably filter out all of the other tweets not being talked about or not being targeted in the search query that we're actually looking for. There's a lot of room for improvement to be made in the actual stock trading strategy. For the sake of making this more of a natural language processing project for now, instead of a stock trading project, I didn't get too involved with strategy and went with simple market orders on a portfolio of stocks that have honestly very little diversity. I just picked a handful of popular stocks, and it just so happens that most of them are tech companies. So there's a lot of strategy left to play with, such as the use of limit ordering, perhaps fine-tuning the bot's way of determining how certain it is with its predictions. I really just made up on the spot the little certainty equation. And this directly affects how many shares of a stock to trade, which is really important. Additionally, the bot purposely pauses between queries so not to exceed query limits on Twitter and Alpaca. So there's about 9 seconds between each stock analysis. Thus, a portfolio of 13 stocks, such as in my case, takes about 2 minutes to cycle through, which creates about a 2-minute window for disaster to strike a particular stock before the bot notices. So fine-tuning the wait times to maximize the queries without exceeding the limits of the APIs on Twitter and Alpaca, because they impose how many queries you can make per unit of time. This is very critical for users with larger portfolios. So if you can make as many queries as possible without having an error thrown from these APIs, then that would be a really good thing to perfect. And finally, like I mentioned in a previous presentation, I think it would be really wonderful to have sentiment analysis play as a complementary role in an ensemble of machine learning models to make good trading decisions. But that is something for a much larger project in maybe the future. For my current model, I think it will take many more days of evaluating my bot's performance to determine if it is actually a good standalone stock trading model. And that's the end of my presentation. Thanks for listening, and here's another 5-hour time lapse of the bot trading on Tuesday. Thank you.